Welcome to this explainer. Today we're diving into a 400-year-old business case study that quite literally built the modern corporate world. We're going to unpack the meteoric rise and the incredibly dramatic fall of the Dutch East India Company, widely known as the VOC. This is a story of incredible innovation, mind-boggling wealth, and the hidden, often fatal dangers of unchecked scale. Let's get right into it.
To really wrap our heads around the impact of the VOC, you kind of have to picture the world at the end of the 16th century. For pretty much all of human history up to that point, a company meant, a small workshop, a local trading house, maybe a merchant family. But then, right at the dawn of the 17th century, something awe-inspiring and completely unprecedented arrived. A single company emerged that could raise massive amounts of capital, establish colonies, build literal fleets of ships, and control the most valuable trade routes on Earth.
Okay, let's dive into this. Section 1, the market problem, spices and shrinking margins. So this whole story kicks off with a super lucrative but highly restricted market, the Asian spice trade. We're talking about spices like cloves, nutmeg, and mace. These were some of the absolute most valuable commodities on the planet, and European consumers were willing to pay astronomical prices for them. But Portuguese merchants already had a total lock on the Indian Ocean. Dutch merchants were desperate, literally desperate to break in, but their initial strategy was just a complete disaster. You had multiple fragmented Dutch trading companies sending out their own separate fleets. They were competing against each other, fighting over the same ships, the same workers, the same ports, the same suppliers. This fierce internal competition was actually ruining their own profits. The Dutch government took one look at these shrinking margins and realized, if we want to compete globally, something radical has to change. Which brings us to Section 2, the radical solution, monopoly and military. So the crucial point is, in 1602, the Dutch government intervened. Instead of letting domestic companies fight each other tooth and nail, they forced them to merge into one single massive organization, the Dutch East India Company, or VOC. They handed this new entity an absolute monopoly over Dutch trade across the Indian Ocean and parts of Asia. And here is where it gets crazy. They received something far more powerful than just a trading privilege. They could build forts, they could maintain armed forces, they could negotiate treaties, make alliances, establish settlements, and, get this, even declare war. This was extraordinary. A corporation was literally granted powers that are normally strictly reserved for a sovereign state. Why? Because the Dutch government desperately needed the VOC to defend its commercial interests against rival European powers, thousands of miles away from home. And the VOC? They executed this monopoly playbook with absolutely ruthless efficiency. They set up their Asian headquarters in Batavia, which is modern-day Jakarta, and just built this sprawling, massive network of ports and warehouses. But the real obsession was controlling the supply. They didn't just want to participate in the spice market, they wanted to totally dominate it. The logic was simple. If you control where the spices are produced, you completely control the European market price. Now, this pursuit of margin protection led to extreme, catastrophic violence. In places like the Banda Islands, which were famous for nutmeg, the VOC's armed forces carried out brutally efficient military campaigns. The local population suffered horrific losses. Also, the Dutch could establish tighter control over nutmeg production. Their commercial strategy was now completely inseparable from military power. Moving right along to Section 3, inventing modern finance. Now, what's really interesting about this is how they actually paid for it all. Funding global fleets, armed forces, and all these colonial outposts requires a staggering amount of money, which meant a total paradigm shift. Before this, a single wealthy merchant would finance an expedition and carry every ounce of the risk. The VOC introduced the joint stock model. They raised capital by selling ownership stakes, shares, to thousands of individual investors. Think about it. If a ship sank, no single person was ruined. But if the fleet returned packed full of spices, everybody shared those sweet dividends. This model allowed them to raise capital on a scale that a traditional family business couldn't even dream of. And because there were now all these shares floating around, those shares needed a place to be traded. Boom, the VOC helped establish one of the world's absolute earliest organized stock markets right in Amsterdam. Investors could now buy and sell their ownership stakes based on information, rumors, and expectations of future profits. Speculation officially became a part of everyday financial life. And for a long time, this system worked miraculously well. The VOC became the most valuable corporation of its era, and Amsterdam became this booming global financial hub. But it raises a really profound question. Does growth automatically create strength? As we're about to see, the answer is a resounding no. Let's look at the turn in our story, where the company's incredible scale becomes its very undoing.
Section 4. The burden of scale. Over time, the VOC had become overwhelmingly enormous. We're talking thousands of employees, hundreds of ships, massive military forces, stone fortifications, and entire territories to govern. It wasn't just a business anymore, it was an empire. And let me tell you, empires are incredibly expensive to run. It forced them into this totally impossible balancing act. On one side, you have shareholder demands, right? Generate profits, minimize costs, pay out those dividends. But on the other side, you have these sovereign government goals: maintain the forts, wage incredibly expensive wars, govern the territories, and project strategic influence for the Dutch state. You just cannot easily satisfy all of these conflicting mandates at once. A company that was explicitly built to generate profit was draining its capital, acting like a government.
So the internal rot was practically inevitable. The entire system began to just collapse under its own weight. Remember, information traveled incredibly slowly back then. You had managers positioned thousands of miles away in Asia with virtually unchecked power over contracts, local trade, and massive resources. With absolutely no easy way for Amsterdam to monitor them, corruption spread like wildfire. Add to that the mounting, crippling military debts from constantly trying to defend their monopoly, plus growing, super aggressive competition from the expanding English and French East India companies. The VOC could no longer control every market, and their hostile take-no-prisoner strategy had basically created enemies everywhere. As time marched on through the 18th century, the finances were rapidly deteriorating. Global commerce was getting a lot more complex. New markets were opening up, industrialization was right around the corner, and that old, rigid monopoly model of just controlling a few high-value commodities, it became completely obsolete. The VOC just couldn't adapt. Their debt ballooned to astronomical levels. Finally, the Dutch government had to step in. In 1799, the VOC was formally dissolved, and its assets were completely absorbed by the state. The most powerful trading company in the history of the world simply disappeared. Let's move to and see how this builds into our modern economy. Section 5. The timeless warning and modern corporate legacy. The VOC might have vanished over 2 centuries ago, but its structural DNA never actually left us. And this brilliantly illustrates exactly what I mean. Just look at every publicly traded megacorporation operating today. Multinational operations crossing borders, capital finance to publicly traded shares, incredibly complex global supply chains, and that constant high-wire balancing act of shareholder capitalism. Now, the VOC didn't invent every single one of these concepts from scratch, but they absolutely proved what could be achieved when you combine them at a massive global scale. They are, without a doubt, the undeniable blueprint for the modern corporation. But, and this is crucial, they are also a blueprint for failure. This quote really hits the nail on the head and summarizes the great paradox at the Dutch East India Company. The world's most powerful trading company rose because it learned how to scale. It fell because scale became impossible to control. This is the ultimate lesson for us today. Business empires rarely collapse because they suddenly shrink or get small. No, they collapse because the very system that made them powerful in the first place, their massive scale, their monopoly, their huge infrastructure, stops working when the market changes and instead becomes a crushing burden. Which leaves us with this final, really provocative thought to chew on. When we look at today's massive, globe-spanning corporations, it's so easy to just celebrate them getting bigger and bigger, but it leaves us with a much harder question to answer. In business, does a system actually become stronger as it grows, or is it inevitably destined to be destroyed by the weight of its own success? It's definitely something to think about the next time you look at your investment portfolio. Thanks for joining me for this explainer. I hope it gave you a fresh new lens to view the corporate world around us. Keep learning, and I'll see you next time.